Hey there, dividend hunters. Iggy the Investing Iguana coming at you with a fresh stock pick that'll make your portfolio sizzle. Picture this, a juicy 6.4% dividend yield, served up hot by none other than CSE Global. Sounds tempting, right? But wait, before you start drooling, we need to put this dividend under the microscope. Is CSE Global's payout a sustainable cash cow or a one-hit wonder? Will this stock keep padding your pockets or leave you high and dry? Don't worry, I've done the heavy lifting so you don't have to. In this video, we'll dive deep into CSE Global's financials, dissect their dividend history, and uncover whether this stock deserves a spot in your portfolio. Trust me, by the end, you'll know exactly whether to pounce on this opportunity or run for the hills. But hey, don't just take my word for it. Stick around as I serve up some cold, hard facts that'll help you make the smart call. We'll crunch the numbers, analyze the trends, and even peek at what the bigwig analysts are saying. Let's get this party started, shall we? CSE Global's 6.4% yield, a closer look, coming right up. Let's dive into the latest news from the financial world. The company in focus is CSE Global, a renowned player in the market. They've recently made an announcement that has caught the attention of investors worldwide. On May 20th, they'll be paying out a dividend of 1.5 Singapore cents per share. This is a significant payout and one that shareholders are eagerly looking forward to. Now, why is this important? Well, this payout translates to a 6.4% dividend yield. In simpler terms, if you're a shareholder, you stand to earn a return of 6.4% on your investment through this dividend alone. That's quite impressive, isn't it? However, before we start celebrating, there's a crucial aspect we need to consider: the sustainability of this dividend. A high yield is undoubtedly attractive, but it's only beneficial if the company can maintain it. After all, a dividend is a portion of the company's profits shared with the shareholders. If the company's future profits are uncertain or if it has substantial debts, it might not be able to sustain such a high dividend payout in the long run. Therefore, while this news is exciting, it's essential for investors to look at the bigger picture. Consider the company's overall financial health, its future prospects, and industry trends before making any investment decisions. Remember, informed investing is smart investing. Stay tuned for more updates and happy investing. Let's delve deeper into the financials of CSE Global. The company's dividend, which is a significant part of their earnings, is a key point of interest for investors. However, it's important to note that this dividend constitutes only about half of their free cash flow. Free cash flow, for those who may not be familiar, is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It's a crucial indicator of a company's financial health as it shows how efficiently a company generates cash. In the case of CSE Global, having only half of their free cash flow tied up in dividends is a positive sign. It means that they have a substantial amount of cash remaining. This leftover cash can be reinvested back into the business, allowing for potential growth and expansion. It could be used for anything from research and development, to marketing initiatives, to acquisitions of other businesses, all of which could potentially increase the company's profitability in the future. Moreover, this also provides the company with a safety net. In case of any unexpected expenses or downturns in the market, CSE Global has a buffer that could help them navigate through tough times without having to cut dividends. So, while the high dividend yield is certainly attractive for investors seeking immediate returns, the fact that CSE Global can comfortably cover this payout and still have cash left over for reinvestment and contingencies is an equally important factor to consider for those looking at the long-term sustainability and growth potential of their investment. Let's take a closer look at the future prospects of CSE Global. The company has projected a significant increase in their earnings per share, EPS, a jump of over 70% in the next year. EPS is a key indicator of a company's profitability and is often used by investors to assess financial performance. A substantial increase in EPS indicates that the company is expecting to significantly boost its profits, which is a positive sign for potential investors. Now, let's talk about dividends. If the dividend continues to grow at its current pace, CSE Global should be able to maintain a payout ratio of around 47%. The payout ratio is the proportion of earnings a company pays shareholders in dividends and is expressed as a percentage. It's a crucial metric for investors as it gives an idea of the company's earnings that is being returned to shareholders versus what's being reinvested in the company. A payout ratio of around 47% is considered healthy and sustainable. It means that almost half of the company's earnings are being returned to shareholders, while the rest is being reinvested back into the company for growth and expansion. This balance is important as it ensures that while shareholders are earning a return on their investment, the company is also retaining enough earnings to fund future growth. Taking a broader view, it's important to consider CSE Global's dividend history. Over the past decade, the company has experienced some fluctuations in its dividend payouts. There have been instances where the company had to reduce its dividend. In fact, if we look at the trend since 2014, the annual dividend payment has been decreasing by about 4.3% each year. This trend of a shrinking dividend is not typically what investors like to see. Stability and growth in dividends are often seen as indicators of a company's strong financial health and its confidence in future earnings. A consistent dividend payout or a growing dividend can be a sign that the company is doing well and expects to continue doing so. However, a shrinking dividend can sometimes raise red flags. It could indicate that the company is not generating enough profits to maintain its dividend payout, or that it is choosing to retain more of its earnings to reinvest in the business or to pay off debts. It could also be a strategic decision by the company based on its financial planning. Therefore, while the current dividend yield and payout ratio of CSE Global are attractive, the historical trend of a shrinking dividend is something that potential investors should take into account. It's crucial to look at a company's dividend history and understand the reasons behind any changes in the dividend payout. Let's further analyze the financial performance of CSE Global. Over the past 5 years, the company's earnings per share, EPS, have been on a downward trend, declining by nearly 5% annually. EPS is a measure of a company's profitability, and a declining EPS can be a cause for concern for investors. It's challenging for a company to increase its dividend when its earnings are decreasing. After all, dividends are paid out of a company's earnings, and if the earnings are shrinking, it could put pressure on the dividend payout. However, it's not all gloom and doom. The company expects its earnings to rebound in the coming year. This could be due to a variety of factors such as new product launches, entry into new markets, cost-cutting measures, or an overall improvement in the industry conditions. If this rebound in earnings does materialize, it could potentially support a higher dividend payout in the future. But, as with all things in the financial world, it's a waiting game. We'll have to see if this expected rebound in earnings turns into a longer-term trend. If it does, it could bode well for the company's dividend prospects. But if the earnings continue to decline, it could put the dividend at risk. Let's take a moment to discuss another important aspect of CSE Global's financial strategy. The company has been issuing new shares, which equate to 10% of their outstanding shares. This is a significant move that can have various implications for the company and its shareholders. Issuing new shares is a common way for companies to raise capital. This additional capital can be used for various purposes such as funding new projects, paying off debts, or investing in growth opportunities. However, while this can be beneficial for the company, it can also lead to share dilution for existing shareholders. Share dilution occurs when a company issues new shares and the existing shareholders' percentage of ownership decreases. In the case of CSE Global, trying to grow the dividend while also diluting shareholders can be likened to trying to fill a leaky bucket. It's a challenging task. The more shares there are, the more the company's earnings have to be divided, which could potentially lead to a decrease in the dividend per share. So, where does this leave us? In the short term, CSE Global's dividend appears to be safe. The company's current financials and the expected rebound in earnings suggest that it can maintain its dividend payout for the foreseeable future. However, the company's inconsistent dividend history and the declining earnings trend over the past 5 years make it a less than ideal choice for investors who are primarily focused on income. Alright, dividend hunters, that's the scoop on CSE Global's 6.4% yield. We've explored the good, the bad, and the ugly. Remember, a juicy yield is tempting, but it's not the only factor to consider. CSE Global's inconsistent dividend history and declining earnings might give some investors pause. But hey, that's just my 2 cents. I want to hear from you. What do you think about CSE Global's dividend?